Greetings, everyone, and welcome to Prince George's Community Federal Credit Union 2022 Student Advantage Webinar Series. Today's presentation is brought to you in partnership with Coffee, a nationwide financial coaching and education center focusing on improving the financial health of individuals. As the premier credit union of Prince George's County, we have joined with Coffee to expand our mission of providing quality financial education to our community and lending insight into credit management, home ownership, and money management. Prince George's Community Federal Credit Union is a full-service financial institution serving anyone who lives, works, or worships in Prince George's County, Maryland. We are one of the county's best kept secrets, with competitive loan and savings rates, as well as discounts to national retailers. We currently serve over 17,000 members in the area and welcome you to come and experience the benefits of membership as well. Later in the presentation, we will display our contact information so you may contact us with any specific questions you may have concerning your financial needs. In celebration of April being National Financial Literacy Month, we are proud to be able to present these webinars and other products to help guide young adults throughout their financial journey. Lastly, today's presentation is available for viewing at www.princegeorgescfcu.org/student advantage. And with that, we will turn it over to Ms. Doris Baker.
Thank you, Gerald, and thank you everyone for joining us today for the presentation titled Credit and Credit Cards. Will your score soar or crash? Now, before we start, let's just talk about credit. Sounds so obvious, what credit is, but it's worth just a refresher. And with that, here's my definition. Anytime a bank, finance company, or business lends you money and you agree to pay it back at a later date, you're using credit. Almost always, you pay for the privilege of borrowing the money, either in the form of fees or interest, but most likely both. As we talk about credit, let's talk about the different kinds of credit as we move on to the next slide. Now, of course, when it comes to money, nothing is ever really simple, and credit is no different. There are 4 kinds of credit. Now, you've probably familiar with them all, even if you don't recognize the names at first, okay? But we're gonna go over them each one by one. First, there's the most popular, and that's revolving credit. And the definition for that is, say you're given a credit limit, okay, a credit card with a credit limit, you can borrow money up to that limit, and each month you can pay it off or you can carry it forward. That is, you can revolve it in exchange for paying interest. Does this sound like your credit card or someone you know credit card? Because it should. Why? Because it is. Now, secondly, we have what we call charge cards. These cards are just like credit cards, except you must pay them off every month. American Express is the best known charge card, but there are others out there. Third, you have what's called service credit. And with this, you essentially sign a contract for services that you promise to pay each month. You do this with your utilities, your cell phone, and your gym memberships. Lastly is what we call installment credit. In this category, a lender gives you a chunk of money upfront, and you promise to pay it back with interest, of course, in fixed amounts over many months. Think of your auto loan or a mortgage. They're both examples of installment credit. You don't need to memorize any of that, but it's helpful just to keep it in mind. And why, you may ask, because your credit score depends on who keeps track of the credit you have and what you do with it. For instance, Not all service credit counts towards your credit score. So let's talk about what does go into your credit score by moving to the next slide. There are 5 factors that comprise your credit score. Any one of these can raise or lower your score depending on how you handle them. But here's the thing, they're not all created equal. 2 of them are actually 3 times as important as 2 others. If that sounds confusing, just let me explain it in plain English by moving to the next slide. 35% of your score is payment history. Now, this is actually the biggest chunk of your credit score. It represents more than a third of your overall score. So exactly what is payment history? Simple. It's how often you pay your bills on time versus how often you pay them late. If you're wondering why payment history is such a big deal, think about it from, say, a lender's perspective. They use your credit score to decide if you're reliable. If you are, they'll charge you a lower interest rate. But if you can't pay your bills on time, that means they don't get their money back. So the worse your payment history, the higher your interest rate. This is why bankruptcies and things like foreclosures, repossessions, charge-offs, collections, and tax liens can crater a person's credit score very fast, and why it can take so long for your score to recover. Let's look at the next biggest chunk. 30% is the amount you owe, also known as your credit utilization. Now, the next biggest chunk of your credit score is equally simple. How much debt do you have? In a minute, we'll talk about tips for raising your credit score quickly, and it'll involve this category. But first, we need to learn about something called a credit utilization ratio. This is a fancy term for a very simple concept. And it's simply how much of your available credit you use at any given time. To figure out your credit utilization ratio, just divide your total credit card balances by your total credit card limits. The resulting percentage is what lenders use to decide if you're a good credit risk and whether you get a good interest rate. Most experts agree that you want your overall credit utilization to be lower than 30%. Why, you may ask? Because it tells lenders, hey, I can use credit responsibly without leaning too much upon it. Let's move to the next slide. So as you can see, just 2 factors are responsible for nearly 2/3 of your credit score. Let that just sink in for a moment. While everyone is bombarding you with life hacks for boosting your credit score, paying on time, and lowering your credit utilization ratio are the quickest and, in fact, the easiest ways to do that. Let's look at the other factors that comprise your credit score, but please don't forget this number, and that is 65%. Next screen. Notice how the percentages now will take a huge drop from here on out. At a measly 15% is your credit history, specifically the age of your credit history. What exactly does that mean? Well, it means everything. all the information in your credit that's about time. Okay, that bears repeating. It's all the information in your credit report that's about TIME. Now, up until now, we've talked about paying bills on time and how much you owe. Now we're talking about how long you've had your credit accounts. How many years have you been paying that mortgage? How many months have you had that credit card? Generally speaking, the longer you've had your accounts, the more lenders like you. Why? Because it shows you have experience managing credit and debt. That means you might be a little savvier about handling a new line of credit. Generally speaking, the longer you've had your accounts, the more lenders just plain out like you. So in a few minutes, we'll talk briefly about how you can use this knowledge to boost your credit score. Let's look at the next 10%. Now we're down to the smallest slices of your credit score. Think of new credit as the opposite of credit history. This category is mostly about hurting your credit score, not helping. With few exceptions, and we'll talk about those in just a bit. You don't want to add too much new credit. In other words, you don't want to suddenly sign up for a half dozen credit cards, okay? When lenders see that, they get real nervous. So you just gotta, just say you got a new credit card, took out a new auto loan, and you got another student loan. Now, if I'm a lender, I'm thinking, all right, now if that person or if this person wants to borrow my money, how will I get paid back if they also owe all these people? While it's only a small piece of your credit score pie, it's still worth keeping this in mind. Okay, moving on to the next screen. Last and almost least is type of credit. This is also called credit mix. Lenders not only like to know how long you've had your credit accounts, they want to see some diversity. Remember when we talked about the 4 different kinds of credit? Revolving credit, charge cards, service credit, and installment credit. Remember that? Well, everything else being equal, lenders want to see you deftly juggling all 4. You're less of a credit risk because guess what? You've seen it all. And if you have a long history of these accounts, you've done it all as well. Basically, what we're trying to do here is put you in the head of a lender so you can understand how they make their decisions to give out money. Once you grasp that, then it's a short step to using that knowledge to raise your credit score. Let's talk about that right now. Next slide. As you can see, your credit score isn't just determined by how much you owe. In fact, if you really look at it strategically, most of it is about timing. Do you pay your bills on time? Have you had your credit accounts for a long time or short time? So how can you use time to boost your credit score? First, of course, start paying your bills, what? On time. Even if you're just making the minimum payments, you can make a huge difference by never being late again. Use technology to remind you. Set up automatic reminders, or even use auto bill pay through your bank or credit union. What if you know you're going to be late? then make a phone call, warn your creditor, and beg, and I do mean beg, for an extension. For example, if you've had a credit card for a long time, it's quite common for your card issuer to give you a one-time extension because you simply forgot to make a payment by your deadline. Now, obviously, they won't be sympathetic if you do this more than rarely, but being a long-time customer can come with some benefits and some breaks. So this is perhaps the simplest, easiest way to boost your score. Just be on time. Before we dive into other tips and tricks, let's talk about what a good and a bad credit score is, because you don't want to waste a lot of time on credit score hacks that really won't make a difference. Next slide, please. Thank you. What's a good credit score anyway? So picture your 3-digit credit score as a letter grade in high school. The ranges above literally correspond with an A, B, C, D, and F. Credit scores start at 300 and max out at 850. It's important to know that 2/3 of Americans have credit scores that are good or better. If you're in the third whose scores fall under 670, which is fair or poor, then you have some work to do, but not as much as you might think. Next slide. Now we are purposefully simplifying things here. We could dive deep into the difference between FICO scores and Vantage scores and other scores, plus all the factors that go into them. But we're now at the point of telling you what you don't need to know. The plain truth is this: you can study the details of credit scoring and become an expert, but how many people want to do that? Like, really? Today, we'll tell you only what you need to know. And you need to know this: there are 3 credit bureaus with scary names like Experian, Equifax, and TransUnion. These are private companies and they compete against each other. What's their business? You are. Your money is their business. They vacuum up all the data about how much you spend and how much you owe, and lenders pay them to get access to this data so they can decide if they'll lend you money. So basically, you don't really have just one credit score, you have 3. And since each of those credit bureaus runs their businesses a little bit differently than the others, your credit score can vary. But here's the bottom line: the difference is negligible. If you focus on the big picture topics we're talking about today, your credit score will soar. Next slide, please. If you should Google, how can I raise my credit score, you'll get more than 64 million results. Interestingly, some of that advice is contradictory, and a lot of it is unnecessary. You can spend literally hours boosting your score by a couple of points, and guess what? It won't even matter. And why, you may ask? Because 1 or 2 points is almost never the difference between getting a line of credit and not getting it. And let me tell you, it certainly isn't the difference between a low interest rate and a steep one. No, today we're talking about the quick, simple things you can do to raise your score by at least 10 points, which can make a difference in a loan decision. We're going to dive back into those now, but we wanted to show you just how your score works. and how big the numbers and ranges are, so you don't get misled into thinking 1 or 2 points is worth a complicated life hack. Next slide, please. So one of the easiest ways to boost your score is making sure nothing is dragging it down. You'd be surprised how many credit scores are suffering for reasons that have nothing at all to do with their owners. What we're talking about here are mistakes on your credit report, mistakes you have absolutely nothing to do with. First thing to know here, a credit report is not your credit score. It's the raw data that determines your credit score. You know, those big three credit bureaus we just talked about, right? They each have a credit report on you with a whole heck of a lot of information about who? About you. With nearly 330 million adults in this country, times 3 credit bureaus, that's a lot of credit reports and a lot of room for error. The federal government estimated 5% of those reports have serious mistakes in them, and that was way back in 2013. It's likely gotten worse since then. Those mistakes can range from saying you defaulted on a loan when you didn't, or you were late paying a bill that wasn't even yours. Maybe someone has the same name as you and a computer glitch assigned that person's debt to you. Maybe it's a clerical error, or maybe it's just unexplainable, but it happened. Now, what do you do? Next slide. You need to scour your credit reports for mistakes. Luckily, federal law makes that free and easy to do. Those big three credit bureaus are required to give you a copy of your credit report once a year. And guess what? At no charge to you. It's free. My favorite 4-letter word. Best of all, you don't have to go hunting them down. You go to one official website. That website is annualcreditreport.com. In fact, here's what the pros do. They request only one credit report at a time. So let's just say, for example, in April, they fetch their report from Equifax. Then 4 months later, in August, they get their Experian report. Finally, in December, they get their TransUnion report. Then they check them to make sure everything they see belongs to them. Why do it this way? Because if they check every 4 months, they can protest a mistake much quicker and get it removed. That's right. You can force those big three credit bureaus to fix mistakes. And here's how you do it. Moving on to the next slide. Now, your credit reports have 5 information zones. First is your personal information, and this is compiled from the credit applications that you personally have filled out, and normally includes your name and current and recent addresses, your social security number, date of birth, and current and previous employers. You'll also have credit scoring results in the summary. Now, this section contains a summary of all of the factors that make up your credit score. They are called reason code, okay? This shows the major contributing issues that will help explain to the consumer why their score may be less than perfect. Then you have a section for trade lines and derogatory accounts. The bulk of your credit report consists of details about credit accounts that were opened in your name or that list you as an authorized user. The account details, which are supplied by the creditor, include the date the account was opened, the credit limit or the amount of the loan terms, the balance, and a history that show whether or not you paid the account on time. Closed or inactive accounts will also show, depending on the manner in which they were paid. They stay on the report for 7 to 10 years from date of their last activity, and sometimes, depending upon what it is, indefinitely. You'll also have an inquiry section. The 3 credit bureaus record an inquiry whenever your credit report is generated for another party, such as a lender or service provider, etc. Inquiries remain on your report for up to 2 years, but only impact your score for 1 year. Then finally, there's the public records section of your credit report. In this section, you will find public records obtained from a government source, such as a court of law, and these would also include liens, bankruptcies, and overdue child support. Most public records stay on the credit report for 7 years. That's except bankruptcies, which stay on for up to 10 years from the date of dismissal or discharge. So you always want to get that credit report and scour over it to make sure that anything that is yours is truly yours. Those things that are not, we're moving on to the next page to see what happens with that. A federal law called the Fair Credit Reporting Act gives you the legal right to easily contest anything that you think is wrong on your credit report. Each credit bureau lets you dispute charges online, and they must investigate. To learn more about this process, you can contact us, and we'll give you that info at the end of this presentation. But the important thing to remember here is an accurate credit report can boost your credit score because mistakes are anchors that drag it down. Let's talk a little bit as we move on about credit cards and about the right credit cards for your lifestyle. If we could move to the next page. Now, there's no way that we're going to be able to deep dive this as well on this topic and name the best card for you. Our goal here is just to show you how many categories of credit cards exist. From there, you can easily find more information. But we also want to warn you about some of these categories. And we'll start with retail store cards. Retail store cards. They are almost uniformly terrible. Yes, you heard me. Terrible. We're talking about cards that are branded not as a general credit card, but it's coming from just one store. Next page, please. Now, whether it's Williams Sonoma, whether it's Lane Bryant or Goodyear, store cards are among the worst. And that's according to creditcards.com, which rates these things. Why do they stink? Well, they charge a lot more than the average interest rates. So if you can't pay off the balance each month, you'll be paying a lot more. And of course, the rewards they offer are only good at that particular retailer. Finally, store cards have some of the longest and densest fine print, which makes it hard to figure out if you're really getting a good deal. And it's easy to get caught paying extra fees with these type of cards. But there's some light. By moving on to the next screen, we're going to show you when they can work for you. Retail store cards have only a few advantages, and it's all about the math. Now, do you shop there often for basic items you definitely need? Then say a card dedicated to a grocery store might be worth it. Is there a great initial sign-up bonus? That works if you're fixing up your house and the hardware store will give you a deep discount on the $2,000 you're spending for the initial purchase, okay? Finally, if you can be diligent about always paying off the monthly balance, you might actually profit from one of these cards, okay? So as long as you're not carrying a balance, as long as there is a way where you can save money, it may not be too bad, but you have to have a plan. Moving on to the next screen. Now, we want you to take away from this what is showing here on your screen. The most important number on your statement is your current annual percentage rate. APR is what you pay for the privilege of being able to charge on your card. And the higher this number, listen up, the more you're paying just to service your debt, okay? The most devious number on your statement is minimum payment due. This is the least you can pay without being hit with a late fee. But don't fall for this. Your credit card company would love for you to pay the minimum because that means you'll rack up even more interest charges. Say you have a $2,000 credit balance with an 18% annual rate and the minimum payment is $10. Do you know it will take you 30 years to pay all of that off if you pay that minimum payment? Okay, just some food for thought. Finally, the easiest number on your statement is the payment due date. But we mentioned it here for one very important reason. You can often get that date changed just for asking. If moving it a few days later will help you meet your bills, maybe because it aligns better with your paychecks coming in, your credit card issuer will sometimes help you out. And I'm here to tell you that most times they will help you out, especially as we meander, through what is or was COVID-19. So that concludes the information I have to share. I'm going to pass it back over to Gerald. Thank you so much for your time.
All right, thank you, Doris. Thank you all for attending today's educational webinar. To learn more about Prince George's Community Federal Credit Union or to speak to a member service representative, please visit www.princegeorgescfcu.org or call 800-952-7428. We'd like to thank once again Ms. Doris Baker and Coffee for their continued support. If you'd like to schedule a free 60-minute financial coaching session, you may call Coffee at 866-459-5165. Thank you and have a great day.